So what we're doing now is commencing a, I was talking to Frank Fahey the other day, and he's been trading the out-of-the-money broken wings for many years now, and he was doing an iron butterfly approach, and we discussed that under the Inside Wire series called Codifying the Fahey Butterflies. And I spoke to him the other day about some of this, and he said, he had recently switched from an iron butterfly to now just doing it all in the puts and then playing around with the calls a little bit. But he had switched over to, instead of establishing a short in the money call as his first decision, he went to the out of the money puts instead for his short strike. And so that started a discussion. Well, let's start putting together a program of what we call best practices for the broken wing. And so in the previous Inside Wires, we have covered the road trip, we've covered the Rhino, the Kevlar, as well as the Fahey. And so what I want to do is go over best practices from all of these. And today we're going to discuss in part one, the best practices broken wing butterfly, implementing the initial position and how that initial position compares to the other strategies, all right, in terms of a 30-day expected return. And we're going to examine this from implementing all these approaches in a high volatility environment and a low volatility environment as well. Now, then in parts 2 and 3, we're going to get into adjustment parameters. That's a discussion Frank and I are having right now, and looking at the adjustments used by these other folks as well as Frank's experience, mine. We're going to combine it all into what we call best practices. And of course, this will have to pass the muster of back testing and ideally outperform other approaches. That's what best practices would mean. So here we go. Let's go to, let's see here. If I just go down, let's just go to the next page. All right, so here are the old Frank Fahey broken wing iron butterfly parameters. And you'll note that there were 4 legs, and he froze it at a 125 points on that extra, on the put farther away from the short. Okay, and basically he would assign the short in the money call, put on the same put, go 125 points away in the put, and then his long call was the adjuster. Now the adjuster approach is what I feel is a part of the best practices. So we're going to keep that part. Also, walking into risk is used by Frank as well as others, and that seems to be another best practices when you put it all together. So, but let's look at the new approach, and Frank and I went over this yesterday and came in for a landing that these steps produce something very close to what he's doing, and it provides consistency no matter what asset you use, what value the index is, or the ETF. It just really works out very, very well this way. And so days to expiration, we're keeping it, and everyone's kind of in line, 60 to 85 days initiating. The short put, where we go and put our short, we could do, short 2 for every one of the longs we put on. We go to the option closest to a 30 delta, negative 30 delta. And what we're going to do in the SPX is favor the 25-point strikes whenever possible in all of this. The open interest at the 25-point strikes is typically much better than in the 10 and 5-point strikes. All right. So we begin with the short put at 30 delta. Then we go further out of money and put on our long put. Now, Frank has been freezing it in recent months at 125 points, but to make consistent from underlying asset to underlying asset, we're simply going to take 5% of the index value and go farther out of the money from that short put. From that short put. Okay, that then gives us a delta number that we're going to then take and use we're we're going to find the nearer to the money or possibly in the money long put, and that will be the delta adjuster that we use. When we do this and it turns out to be pretty much right at delta of around 0, typically what you'll find if you're in this date range, days to expiration range, is that your entry debit should be less than 5% of the initial capital required. So in other words, if your initial capital is around 10,000, the debit would be under 500. All right, and that's what you'll typically find. That's one parameter. That's what the road trip uses. We find that just you doing this by itself will automatically fit you into this parameter, but we're going to list that anyway because it's just something, just a good gauge to make sure that you're starting out pretty well there. And then again, we're going to scale in half of our capital at a time. It seems to be a very valuable practice used by several folks. So let's take a look at what this looks like. Let's first go to a high implied volatility environment where the IV percentile was at 80. I've used this date in the past, November 2nd, 2016. Implied volatility is very high relative to the previous year. We are underneath the 50-day simple moving average. If you're following along the DiscoverOptions curriculum, you would know that that is not a favorable environment to do these campaigns in. But nevertheless, to do the comparison on high volatility, low volatility, just looking at the expected returns, we're seeking this high implied volatility percentile level, and that typically means often we have to be underneath the 50-day simple moving average. So, and I wanted to be consistent with the dates that we've used in the past. So just keep that in mind. If you're following along using the volatility edge analysis parameters from the curriculum, we wouldn't use this date, to be quite honest. But let's move forward and continue with the comparison. So here is where we begin, and I had to carve up the matrix. I didn't want to just grab a huge matrix, 5-point spreads, and then you have to get your magnifying glass out and go up snug next to your screen and press your nose against the screen to see these strikes. So in other words, so what we're doing is we first go to the short put, as close to 30 as we can here, and we're going to favor the 25-point strikes when we can. In this case, we're going to, instead of 29.9, we're going to go up to that 30.8, which is the 25-point strike, which has a significant amount of greater open interest there. All right, so we begin there. Then we're going to go further out of the money, 5% of the index value going further out of the money from that place. And we're going to favor the 25 points if we can round to those. So in this case, the index is at 2097.9. 5% of that is about 105 points. That takes us to the short strike starting at 2025. Reducing that by 105 takes us to 1920. So we go to the 1920 strike, and we notice that we're very, very close to that little 5 extra, that 25 point instead over here, and that's just easier to trade in the SPX. We're going to go ahead and grab that. We then take a look at our deltas, and it's now time to use the delta adjuster. We're going to come up here to the closer to the at the money or possibly in the money puts, and we have to put on a 5 lot. So when we do the math here, looking at the deltas here, we've got a 33, a 48, and a 50. We realize that if we put a 5 lot on right at this 2090, okay, at the 2090, I didn't show the 2090 here. Works out that the 2090 is going to give us the delta closest to 0, and our cash flow works out to roughly 3.5%. Our debit is at about 3.5% of the capital required over here. Okay, so that works out pretty well. So those are the steps to get into this approach. Let's go take a look at the analyze screen. Oh, first, if we're going to analyze, I want to do this because we're going to use expected return over the course of a bell curve. What are we going to use for that bell curve? Are we going to just use the at the money put IV? Okay. Well, here's what I'm going to ask you to do. And I find this to be a bit more accurate because we're very concerned with downside movement. And so what we're going to use is the skew adjusted volatility, looking at and I would ask you to go review the inside wire from May 23rd when we went over using a skew adjusted, looking at skew adjusted expected returns. All right, we basically we plug in the at the money up here, and then we go to the one standard deviation IV and replug that back in to get a more accurate downside expectation. And then that will define our expected returns from across the bell curve. We're using a little bit larger of an implied volatility than what you'll see typically others use, or what statistical will typically be there, but that's okay. We want it to be accurate on that downside move, which if it does occur, we have a good feel for the expectation on that move. So we're substituting the correct volatility into the SV volatility box. Now let's go to the analyze screen, and this is what your put butterfly will typically look like. And what one feature that's nice is that the expiration line across here is very, very close to the zero break-even line there. Okay, we want to be within 5% of the capital required. Here we're at about 3.5. And so that's working out well. Now I'm modeling this at 40 days. I'm going to recast this modeling and show it instead at 30 days out. And that way we'll be able to zero in and get a feel for what's truly going on here. And there you go. 30 days out, you can see we're leaning a tiny bit squeeged short. All right, we've zeroed in a bit more, looking at 40-point increments, 30 days out. And one feature you'll notice is that we do have some hedging going on the downside. As time kicks in, we have a bit of a skew over here. We're a little bit more protected on the downside than we are certainly on the upside. And that's kind of something in common with these approaches. Now, some might want to buy calls and just lift this up and really make that thing level. And that certainly is understandable. That's a discussion Frank and I are having. That's a tactic that he likes to use to flatten that thing out. But we are currently in discussions on that and coming up with best practices. All right, now, so this is the best practices T+30 line. Let's now, and rather than show you the rules for each one of those other butterfly approaches, I'll just simply reference the inside wire dates. You can go look in the archives. That way we don't have to go over each one of them in the interest of time. So the Kevlar Butterfly came from the March 7th, 2017 inside wire. Okay, take a look at that one. It's a little bit, here's the one we're using now. You can see that the peak here is right around well, I should have used yield on these screens and I didn't, but you can see very similar looking screen. Later I'm going to superimpose these with yield as the left-hand axis there. Actually, let's just go to the right-hand axis. You can see we're pushing up near about 10% here. Here we're a little bit over 10%. All right, but you'll notice that it's more steeply inclined on the left side of the screen. So Kevlar looks similar, but we're going to superimpose this in terms of yield in just a little bit. The road trip, which is basically a 40-50 butterfly, you have 40 points going upward in the puts, 50 points going downward, and you know, it works out real well there when you position the initial long snug up near the at the money put right around there. It's kind of, you want to be within 5 or 10 points, and this is kind of what the look is here. You can see here it's pushing 14% on that upside. Not too bad. And then we go to the Rhino. The Rhino butterfly. Again, pushing up to 14, a little bit higher. Now, let's superimpose all of these. And what we're going to do is look at down here, we see the expected return and then the standard deviation. Now, real quick, expected return looks across the width of the bell curve. It takes 11 data points from the width of the bell curve, multiplies each of those times the probability of occurring, adds them all up, and you then get an expected return. And then the difference between that expected return and each data point is averaged up, and you have then the standard deviation. Well, it's not averaged up. Of course, we use the standard deviation protocol, some of the squares and all that stuff. But you can see there that we're at a positive 1%, and then 11% is the standard deviation. So again, you have the best practices in blue, okay, and the other ones are the other colors. Notice that the best practices gives us the most protection on the downside. The break even is farther down than the others. The gain right around the at the monies are the lower of all of the other three. But one thing you'll notice is that given this shape, well, let me just show you the statistics here. Okay. The best practices, expected return of 1, standard deviation of 11. The Kevlar had a positive expected return, but the standard deviation was a bit higher. The others had a 0 expected return, and the standard deviations were much more volatile by quite a bit. And so you can kind of look at that screen and kind of tell the blue line is a bit flatter than the others. The others are more curvy and slopey, I'll just call it. The blue line, the best practices, is less slopey and less curvy. Just putting it in layman's terms there. And that's a good thing. Plus the blue line has a positive expected return. And this is a feature, and you'll note if any of you have talked to Frank, talked to Frank, you'll know that he favors that T+0 line to be as flat as possible, and and he's willing to accept um, the lower part of this blue line being underneath the others in return for having it be flatter across the width of a greater price range. It's just a safer way to trade. But we have a positive expected return and less slopes and curves. All right, so that was the high volatility environment. Let's now go to a lower volatility environment and do a similar comparison. Here we are on, when was this? I'm going to say this was March 3rd, right around there, of this year. Implied volatility was quite low. The 1 year percentile was at just 2. We're way above the 50-day simple moving average. This would be a typical environment that we would favor given the volatility edge studies that we've done and reported on to you. And let's now go and take a look at the 4 lines. Once again, the best practices is the blue line right here. And you'll note that it has the break even is farthest on the best practices, that has the best break even to the downside. And all in all, I think you'll see that the blue line probably, again, has less slope and curve to it than the other 3. Some of them get very high up here. And on the downside, on a downside move, you have it get quite sloped there. One interesting thing is on the Kevlar, you'll see this is the red line right there. The Kevlar involves buying a put, doing the put butterfly, but then buying a call to then lift that right side up a little bit. And that is a tactic that Frank kind of favors sometimes, and it's used in the Kevlar. And we're kind of going the road we kind of like that as maybe a possible future adjustment. But for starters, I mean, that looks pretty nice, actually. Let's go take a look at now the comparison of all four with each other in a low volatility environment. Okay, the best practices has a positive expected return of 3, standard deviation of 15. The Kevlar is at a plus 5% expected return. Standard deviation is a bit higher by quite a bit. Now that 5%, some of it is coming from over here where it's, the edge of the standard deviation, it's catching some of that. Now it's not really, it's not weighting it a whole lot because it's out on the edges, but it does factor in. So buying that call reduced the return on the Kevlar downward, but it still is above, the best practices over here. Nevertheless, you can see that it also, it gets kind of sloped there on the downside. And that's kind of lends itself to having a higher standard deviation across the bell curve. So that adding a call is something to take a peek at, I think, um, as we move forward in my discussions with Frank and as we come into part 2. The road trip, negative expected return and a much higher standard deviation. That's not good. And the Rhino had a smaller expected return and the highest standard deviation of all of them. All right. So that's the comparison of them all. This is how we're kicking things off on implementing the best practices broken wing, and we'll, you got the Kevlar, the Rhino, the road trip. Maybe we'll come up with a cool name in the future, other than BP, BPB, WB. We got to figure something out. Reminds me of Twampum. Who's that guy? He was a futures educator many years ago, and he had this handbook called the World's Best Trading Handbook for Profits. It was called, but the acronym turned out to be just Twampum. It's kind of interesting. Okay, any questions, comments? I think that's the. Oh, and here's the total comparison, comparing them all: high IV, low IV. All right, and I think the best practice is when you combine it all, works out. It definitely has the lowest standard deviation of all of them. The expected return didn't quite match the Kevlar over here, but standard deviation kind of made up for that. All right, and we're coming in is on a complete trading system using this, inclusive of adjustments, and we're going to throw in the timing on the volatility edge analysis as well. That'll be another part of our discussion moving forward. All right, awesome. Thanks so much for everyone joining us. We'll be back next week with part 2. Take care. Have a great rest of the day.